welcome back to the Conch Economist. I'm Merle Denbath, your Conch Economist, and I'm going to talk today about a value that is not discussed at all, but is very important to many of the activities that happen to us today economically. I want to welcome you and tell you that our goal here is to help you be your own economist, to try to help you improve decisions that affect your life, considering all of the forces that influence us today, the problem of high prices, the problem of tariffs, the problem of international conflicts, and even sad situations like senseless killings and lower job opportunities, apparently, according to some of the recent data. So there are so many things out there that influence our daily lives that we hope that what we do here can help you in your decision-making process and better understand what's going on. The Federal Reserve, of course, is going to be meeting this week, and it's widely anticipated that they're going to be lowering certain interest rates, and we'll be talking about those in the program today. And I will be talking about this value that is not being discussed at all, but is a very important one. But first, I would like to review some of the interest rate developments in the last 2 weeks. What we have on the screen now are some interest rates that I have obtained from the Wall Street Journal. These are rates that can be obtained from different sources, but that was convenient. And it's interesting to note that over the last 2 weeks, August 29 to September 12, home mortgage rates, and I'm talking now about 30-year fixed, have declined from 6.56% to 6.35%. Now, admittedly, that's not a large drop, but at least it is a decline in mortgage rates, which will be helping some. We have seen a pickup in applications for home mortgages. From a basis points point of view, that's only a 21 basis points drop. And in one of my previous programs, I discussed basis points. So if you need to freshen up on that, you can look at one of my earlier programs on basis points. Actually, I discussed them in 2 different programs. From a percentage point of view, it's a decline of 3.2%. Now, I call that to our attention because what's interesting is over the last 2 weeks, other major interest rates have held steady. For example, the U.S. prime rate. This is the rate that banks charge their largest and best customers, 7.5%. The federal funds rate, which is one of the interest rates that the Federal Reserve sets and is considering changing next week, according to a lot of speculation, to be sure, but that has been holding right at 4.33%. Now, bear in mind, these are major rates of interest that have not changed, but for some reason, home mortgages have declined, largely in anticipation, which indicates that home mortgage rates can change even if the overall fundamentals don't. The discount rate is another rate that the Fed will be influencing at their meeting on Wednesday. That has held constant also at 4.5%. So even though the federal funds rate has held constant, the discount rate has held constant, the prime rate has held constant, we have seen a decline in home mortgages as far as the interest rate is concerned. And this is 30-year fixed. Well, this mysterious value that I have reference to is something called present value. Now, what is present value? And sometimes it's identified as PV, the acronym. It's the amount of money that we would have to invest today to provide for a larger amount in the future, which we'll refer to as FV, or future value. And for right now, for our example, I'm going to assume that we need $100 at some time in the future. That's a modest amount, but it'll help illustrate the point. There are 3 things that influence this. First of all, how many years in the future are we concerned with? And we can go out 30 years. In my example here, I'm going to use this 2 years because that will illustrate the point I'm trying to make. And I should also point out that it doesn't have to be a yearly basis. You can do this on a weekly basis or a monthly basis, however you want to define your period of time. The period of time that I'm going to be using today for this little example is 1 year. The period of time is sometimes referred to as the little letter N. So I've put that there to make reference. I'm going to be coming back to this in future programs, and I may just refer to it as N or some other amount like PV or FV. The interest rate is very important, which is why we are so much concerned with interest rates today. Interest rates are sometimes identified as little I, so I've indicated that to indicate the acronym or symbol that's used for the interest rates. And for my example today, I'm going to be assuming a 4% rate of interest on an annual basis or a 5% rate of interest. Now, let's assume that 1 year from now, we need $100. We want to save up for $100 for some purpose. Now, understand it could be 1,000 or 10,000 or 100,000, but let's just keep the arithmetic simple here. We need $100. How much would we have to invest today to give us $100 a year from now if we can get 4% on our money? And the answer is $96.15. $96.15 invested today at 4% a year from now would be worth $100. In the language of a financial textbook, $96.15 is the present value today of $100 a year from now at a 4% rate of discount. Now, let's assume that we don't need this money next year. We need it maybe 2 years from now, okay? Same rate of interest, 4%, same amount that we need 2 years from now, $100. We would now have to invest only $92.45. $92.45 invested today at 4% would give us $100 2 years from now. Now, we are assuming annual compounding. In other words, the $92.45 after 1 year would grow to $96.15, and then after the next year, it would grow to the 100. So in other words, we are earning interest on interest. So one thing to observe right now is that as far as present value is concerned, it is influenced by time. The longer the period in the future that we are concerned with, the lower the present value today. $92 is less than the 96 because it's a longer period of time, even though the interest rate stayed the same at 4%. So there is a relationship here, an inverse relationship between the time and the present value. The longer the period of time to achieve your financial goal, the lower the present value would be today. Now, let's assume, however, that we can get a higher rate of return, 5%. Our $100 now, 1 year from now, we would only have to invest $95.24, a lower amount. Since we can get a higher rate of return, that $95.24 would yield us $100 a year from now. And again, in 2 years, we see a similar pattern. The rate would be even lower. 2 years from now, $90.70 would yield us the $100 in 2 years at a 5% rate. And again, assuming annual compounding, the $90.70 would grow to $95.24 in 1 year, and then the $95.24 would grow to $100 in 2 years. Now, what does all this show us? Well, it shows, first of all, as I indicated, that there is a relationship here between time and present value, but most importantly for today's world and the Federal Reserve meeting this week is the relationship between interest rates and present value. If you are concerned about why does the stock market go up if interest rates are going to go down, this is the reason. Because if interest rates do go from, say, in our little example here, from 5% to 4%, to achieve the same rate of interest, we see a change here in present value. For example, the 2 year period, by going from 5% to 4%, the present value has gone up from $90.70 to $92.45. Think about this as a price of stock. Why would a stock go up? When an investor makes a purchase of a stock, they are anticipating the future. What is the price of the stock going to be in the future? What will the dividends be in the future? And so we can see that if the interest rates go down, our present value, in other words, the amount that we're willing to pay today for either a bond or a share of stock, will be higher. Hence, we see this past week that the stock market was again hitting all-time highs. So there is an inverse relationship between present value and interest rates. As interest rates go down, in this case from say 5 to 4, or what we're hoping the Fed will do in the coming week is to well, they're hoping maybe a quarter point drop, and some people are hoping for a half a point drop. Remember, a quarter point, that's 25 basis points. A half point drop, that's 50 basis points. But the federal funds right now has been in the range of 4 to 4.5%, so they're hoping to bring that down to say 4.25 to 4, or maybe even 3.75. But whatever it is, if there is a decline in interest rates this week at the Federal Reserve meeting, the hope in the market, the anticipation that in the market is that this will generate lower interest rates across the board, which will make for higher present values. Higher present values mean that we are willing to pay higher prices now for a stock than we did, say, a year ago or 6 months ago. Now, there are some other offsetting possibilities here, and that's in the area of insurance. Insurance companies invest large amounts of money because they need to prepare for future claims, and they need to get a rate of return to provide them the wherewithal to cover claims if they do have claims. Now, obviously, from the point of view of an insurance company, they like to get a higher rate of return because they can be more assured of having the necessary funds to meet any emergencies that might arise. Now, notice that if interest rates go down, and present values go up, from the point of view of insurance premiums, this could put upward pressure on insurance premiums, because now insurance companies are going to have to invest a larger amount of money to achieve the same $100 a year from now, or $100 million, whatever it is that they need. So lower interest rates can be a two-edged sword here with reference to housing. Yes, interest rates will be lower. That would be nice. The home buyers would appreciate that. But at the same time, there could be an offsetting factor of higher insurance rates, because insurance companies now will be faced with the fact that the present value of a premium has gone up, which means that your insurance premiums could go higher to provide for the income that the insurance companies that would need in the future. Well, who will benefit from lower interest rates, particularly if we are able to see a decline in mortgage rates? Well, the home builders should benefit because they have had to have special financing arrangements, maybe buying down a mortgage for a couple of years so that people could qualify to buy a new home. In one of my previous programs, I pointed out that if you compared the advantage from a monthly payment point of view of either a 10% drop in a mortgage rate or a 10% drop in a house price, you get a little better advantage with a 10% drop in house prices. And if we're going to see a decline in house prices, this would be, of course, from existing homes that were built many years ago. If you look at some sources like Zillow and look at houses that are for sale, and if the house was bought by the current owner, if it was bought, say, 5, 6, 7, 8 years ago, you will probably find that the price that they paid for the home is maybe half of what they're asking for it now. This means that there's a lot of opportunity there for those prices to come down. New home prices are rather sticky because labor is fixed, materials are fixed, the price of the land is fixed. There's not much room there to lower prices of new homes by the builders. The best thing they can do is try to offer some more attractive terms, which they've tried to do. But as far as existing homes on the market, the real opportunity for lower prices would be there, particularly for people who are maybe out of the house. It's kind of interesting to notice that sometimes when you look at the photographs of the houses, they're empty. So you've got a house sitting empty, but insurance still needed to be paid, taxes still need to be paid, utilities still need to be paid. So this gets to be quite a cash drain and can be we will see two different kinds of benefits from a housing point of view. New home builders will benefit from lower interest rates because now people can qualify for the new home with maybe no longer the possibility of having to have buy downs and so forth. And other home buyers can perhaps benefit from a decline in the price of existing homes. There are some other things that we need to be aware of. Lower interest rates can and probably will result in continuing decline in the value of the dollar with reference to foreign currencies. We've seen quite a drop in the value of the dollar from an exchange point of view in recent weeks. And with lower interest rates, that can continue. Now, what does that mean for inflation? Well, it means higher inflation because, as I've indicated in previous programs, you go to Home Depot, go to Walmart, go to just about any store that caters, that's a retail operation. There's a large amount of the inventory that's imported. And so imports will go up in price. And so you combine a lower dollar to imports, and then on top of that, possibly tariffs, there's going to be a lot of upward pressure on prices. So if there's any benefit from the coming lower interest rates, hopefully it will provide some relief to people trying to buy a house, and maybe it will help to stall the declines we've seen in the employment market. The labor market recently has shown some softness, and hopefully maybe lower interest rates will arrest that. Well, that's all for today. Thanks for watching. Thanks for subscribing. And we invite your comments and look forward to seeing you next time.